Trying to figure out how I can get it to stream in 1080, but I can't. Okay, just wanted to talk to you guys today about a quick option strategy that I've been working on. It's called the broken wing butterfly, and I mean it's a
Hello.
simple strategy. It has a couple components to it that will help you no matter which way the stock goes. You just have to kind of stay on top of it. Okay. Just before I start, I'm giving you guys today is the 27th. Just a quick overview of what's happening right now. Healthcare, industrials, utilities. Okay. And to give you an idea of what I'm doing, let's look at Procter and Gamble. Today, I am looking at Procter and Gamble to try to see if I can make a little bit of money by Friday on this. Okay, the way to make money on options, for the most part, I mean, obviously, I've already explained that an options is just a contract. You can buy it and sell it at a higher price. So if you expect the price to go up on an options, you can make as much money as you expect it to go up. You should do the math beforehand and buy as many multiples as it takes to get to your target. So if I want to make $20, I can buy an option for $10 and sell it buy two options for $10 and sell both of them at a $10 increase, and now I've made my $20. Or you can wait until it goes up to $20 or whatever which way you want to get to it. But what I do is the broken wing butterfly worked for me last week with space, and I like it because it allows me to both buy an option and sell an option. And what I want to do is be able to sell options without having to have too much collateral. Okay, so I think I've already explained collateral, but just in case I haven't, when you buy an option, you are buying the right to purchase 100 shares of the underlying stock, at a set price by the expiration date. So buying a call option will automatically set you in with 100 shares. Buying one option gives you 100 shares of this underlying, but you can only play it within the options chain. Okay, so what I'm gonna do is called the broken wing butterfly. I've said it a million times already. This is the way that it looks. Just to give you an overview, you buy a call at strike price A, you sell two calls at strike price B, you skip over C, and you buy another at D. So in total, we're going to be playing with four different stock options. And here's some notes on it. The strike prices are equidistant. All options have the same expiration month. So this is on the same expiration. This is for if you're slightly bullish, and you want the stock to rise to strike B and then stop. So B is where I want it to stop. And B, what I'm going to set for B is going to be 128. Now, here's something that you should understand and that I'm aware of. For one, this is the weekly. I'm looking at the weekly here, and it was given a buy signal last week. Okay, and it's still above the zero line here, so it's still on an uptrend, and you can see that here. It's following an uptrend, but it has reached a top. When we look at this underlying and we look at it all the way since its inception, it has reached the top, tippity top that it has ever reached. It reached the highs from before the fall in February. Okay, so what does that mean? That means that anything can happen right now. If I believe that the entire market is going to fall, then this will fall, or I believe it will fall, and that could happen at this point right now. We've already reached the top point, but to be completely honest, we have to go along with how the market is moving, and the market is moving in an up direction. Right now, it's kind of ranging, and we'll see that when we go in. If I go into the weeklies, actually, if I go into the dailies, we'll see that it's already starting to picking up here. This is what's been happening on the days since March. Let's move away from March and come over here closer. It reached a peak over here in April 17th, which was the last earnings that it had. So it reached its peak on the last earnings. The earnings were at a surprise of -2 cents, which is per share, not a big deal, 1.40. It shouldn't have been a huge deal. And it was still reported up. So it says here, as reported, 112. And the estimate was 13. I don't even know why it says 2. So it's not a big deal. It came out as everybody kind of expected, and it shot up. But after it shot up, after all of that, it came back down. And that is kind of what I am hoping will happen again. Maybe not come all the way back down, but if I set this line here as a resistance, as a support, and this is the resistance up here. Let me get rid of these lines. Oh, let me just not show this for a second here. So I put it up at, this is as high as it's ever gone, and this is as low as it's probably going to be bouncing to. So it'll be trading in this range up until August, and then it'll break out. That is what I expect if things happen to be going in the same range. You know, if it doesn't, if nothing, no big news comes out or whatever. If on the 30th, which is on Thursday, if it pops, if it says that it's good, it's probably going to pop up. Okay. So what I want to play is something until here, which is the 31st. I'm going to make this a little bit more visible now. So this is the line that I want to reach, and what I'm reaching here is a little range here. It could be that on the 31st it pops up or whatever, but I don't expect it to go higher than this range here. Okay. I don't know why I don't expect it. I have been noticing that prices are finding their balance. They're finding their ranges. So I think that's what's happening with this. It's going to end up finding a range. If I come over here to the 15-minute range, this is the range I'm talking about. Okay. It came up here to this point. Once it found its little thing here, it came back down. So let's make this into the July 13th. This is the beginning. This is the high point that happened last time. Okay. And I'm going to make it more visible. Being the high point, I'm going to make it green so that we realize that this is an old resistance line that it has. Okay. If you notice, it came down to that line again. Once it went up there, it came back down to this price down here. Okay. So I'm also going to put this as the average. Okay. I'm going to make this into the support line. And I'm going to average it out with these guys over here. What I try to do is find out when it last came to it, and then I bring it down, because this is how it's trading. I don't know why it follows those rules, but that's just the way it is. Okay. So this is going to be our support, as low as it should go. I'm going to get rid of the bigger line over here because I'm not looking at it on a long range scale, on a long range. I'm just looking at it a small one. This is the long range here. This is our point. So now I have this little square here, and things start to get a little clear when I draw these things. Let me see how I can make this space here be known. This is tied to something. Why can't I grab it now? Make it big, make it a little more bright. This is what's left, okay? And this is the range that it can go up. And this is the range that it can go down. I'm gonna put it like around here, even though it could go lower than that. Okay, so this is the space that I expect it to range in, 128 and 125, okay? So this is perfect because there's at least 3 whole dollars in there. So I can make it work with that. And I'm gonna, this is where I have come to the conclusion. I believe it's gonna range up until this point. Maybe it'll break out. If I start to look at indicators and stuff like that to see what will help me get a little bit more, the Bollinger Band say that the highest it could reach right now is 126 from where it's at, okay? From where it's at right now, 126, and its lowest is back down at the 125, which is down here. So even the Bollinger Bands don't believe it could go too high at this moment. It's trading really tight. Let me get rid of the Bollinger Bands. Let me get rid of volume. Actually, let me look at volume and compare it. Notice that volume, there's a lot of down volume here, okay? Once it gets up to a certain price, people are trying to sell it. It didn't take too much to get up here. I don't know how it gapped up like that because it didn't take too much. But I guess it was going up. People liked it. Maybe there was some news, something happened in the market that caused that, but immediately there was a huge sell-off. So people are waiting for these things to get up to certain prices and sell them off. Okay. There's a lot of people waiting to sell this off, maybe trying to get out. We know that the market is probably going to have a correction real soon. So there's a lot of people who are going to be bearish overall. And even if they're not bearish, they're just trying to cover their asses. You know what I mean? So once it gets up to higher prices, people are going to sell off. And here it might be good because that means that everybody already sold off from here. So maybe now people are just waiting on the up. Anything could say that this is going to go up. And if we're believing in the way the markets are moving, this will go up. But I think it'll go up next week, not this week. Okay. That all depends. Earnings is a very volatile moment. Anything could happen. It'll probably raise up. And that's exactly why I want to play the earnings, because I expect people to buy more into it with the earnings. Okay. So I know that because people are going to buy more into it, I, who want to make money off of these people, I will be selling them the options. I want them to believe that it is going to grow. So here it is. I'm selling this to you. Go ahead, do whatever you want with it, and hopefully it doesn't go higher, because that would make me lose money. Okay. So when I'm selling, just to have a quick overview, when I'm selling an option, if it goes higher than the price that I'm selling it for, I will be paying that amount. Okay. The premium that I collected for selling it, I technically get paid for selling it already. And after that price is where once it reaches that price, the highest that I sold it at, if it goes higher than that, I'm only going to be paying more. I'm only going to be paying whatever's left. Okay. And that means that at the end, I'm going to pay whatever they are giving me plus it'll be included in the price, whatever they're giving me, that will be taken away. Obviously, I won't get that premium. Plus, whatever goes up, that's what I'll have to pay afterwards. So when you sell an option, you kind of want to cover your ass in case it does happen to go up. And that's where the collateral is for. The collateral covers you on a cash basis, so that you actually have the backing behind it. If I try to buy things off collateral alone, I might be able, I notice right now, I probably have the money for the collateral as it is, but let's not get into any of that. So I want to do this broken wing butterfly, right? And I want to sell and where I believe it definitely will not pass. Okay. And that's the 128 line. Okay. So I come over here, and when I see the sell, the strike price B, where I wanted to be sure that it will not pass, or at least that it won't pass by the expiration date. The strike price B that I have is 128. Okay. So 128, right now it's at 105. I'm going to sell it, and I'm going to sell two of them. Okay. That's the strategy on the selling part. And it says here, so you you sell two calls at the strike price B. So strike price A is going to be $1 whole down, and that's going to be the 127. Okay. So they're already going to pay me $68 for this because it cost 140 here, but I am selling 104 times 2, so 208, right? And 208 minus 140 is 68. So, and then it's on the strike price D is two whole stops. So 1, 2, 130, and I'm going to buy this too. Okay. So it'll be $15 that they pay me, 15 cents that they pay me times 100, that's $15. And when I come over here to look at, this is what I had before. I've done this a couple times already, so I'm sorry, but let me fix this up to be completely sure. This is already at the 127, 128, 130, that's perfect. Sell the 128, there it is, everything's here. Okay, so this is the probability that it'll be under 129. Let me actually put it as the summary. At the summary, there's a probability that it'll be under 129, and for me, what I want it to be is really under 128, but I have this 130 call, so it's including that. But it's probably going to be 88% chance that it'll be under 129. If I bring it down to 128, which is where I want it to be, 88% chance. Oh, sorry, 78% chance, which is still pretty fine. The guy who taught me how to sell or whatever, he sells things at 70% chances. He just throws it out there. So, if it works, it works. If it doesn't, it doesn't. but you have a 70% chance in it. And if you're trading 100 times, there's in a 70% chance, there's 70% chance you're going to get the out of that 100. Okay, so that's what that means. The longer you keep trading at the same percentage, the more it'll actually reach that percentage that you have overall. Okay, because sometimes you're wrong, like in this I really believe that I might be wrong about this PG strategy, but that's how I want to play it out, because I do believe that it won't pass 128, at least not this week. Okay, some crazy shit would have to happen for it to pass, and it is totally possible, but I'm not going to bet on it this week. So far, everything is still kind of stable. I don't know what's happening. Maybe we're definitely at the new normal when it comes to the to this bullshit. The what is it? The chart of fear or whatever. I don't know what it is that it's called. The I forgot the name of it, man. Market crash psychology. Right here. This is the one that we use overall, but I noticed that there are some other ones here too. So here's where it should be. This was the easy one, but we are already at complacency. Okay. So we've reached this point. I just want that to be expressed. If you look at we actually went higher. We're already, if you look at these charts here, you notice that we already reached that stage. Up, up, down, down, and then complacency. We're genuinely right at the edge here. Anything can happen. And I kind of believe that it was sort of will happen very soon, just not this week. Okay. So that's good enough for me. And here is how I would play it. It's gonna pay me $15 to play this strategy right now. Here's what would happen and how I would play it out. Okay. Let's say the week. I'm gonna put this on the daily so that we see. I'm gonna put it on the. Yeah, on the. Actually, I'll put it in the hourly. Okay. I buy this play here, right? And what I'm trying to do is sell the 128. So I expect it to go under 128. And the way that the selling of options work and how to make money is that you are placing, they are paying you for this, and this is the collateral that we're using. So you're selling to open at this price, and what you want is this price to go down so that you can buy it back. Okay, and you buy it back at a much cheaper price, and you keep the difference, whatever it is that you sold it at originally. I'm sorry, whatever it is you put it to sell originally. When you buy it back, you keep that difference. Okay, so if it goes down to $80 or whatever, I buy it back, and even though I pay $80, what I'm really keeping is $20 or whatever that difference is. Okay, now it is the complete opposite with when you're buying stuff, when you're instead of selling. If the price goes above a 128 on this 127 call, I'll start making more money off of it. Okay, and if it gets up to 130, I'll start making more money off of that. But that's all being offset by this right here. Okay, if it stays within the 127 and 128 range, I'll probably keep this amount, whatever the difference is here, and then this will be expire worthless. So I'll lose the money there. Okay, but I'll be able to keep whatever differences is, and it'll probably be, the difference will probably be that. Notice that it's at 106 and this is 143. It's a little less, but it'll probably be somewhere around that range. And what I want to do to be able to make the money separately, in case there is a sort of craze that I can't actually follow, this, I'm going to be looking at it the whole week. If it comes up here, right now it's down here at 126, and I'm doing the 128. I could probably even wait for this to come up here, and this will be worth a lot more. And I do the whole selling thing, and it'll be worth a lot more. But overall, the prices are kind of going to be the same thing. So even if it did go up or down, this particular spread will be somewhere around the same price. I saw earlier the same spread was worth just a little bit more. Maybe I can wait until it goes up higher, because it was up higher earlier today. This is how it started the day. No, it's here now. It was up here. So when it was up here, it was worth just a little bit more. I could have bought it then and made that premium then, whatever it was. And it was just a little bit more. I want to show you guys really quickly how it looks on this is the when I put this into this calculator, the entry cost is 19. The maximum risk in case things go wrong and the price goes up is going to be $81. That's keeping it, if I keep the spread exactly as it is, and I'll explain more now, then the maximum return, keeping the spread exactly as it is 119 right here at the end, at expiry of $127, because I put it for 128, so it should stay $1 less. Break even at expiry is 128.19. Okay. So the way this works is when I'm done, I'm gonna sell this call for $75 since it's in the money. So if it's at 126, if it's at 126.75, it'll be 75 cents in the money. So it'll be worth 75 cents. I will buy this back and it'll be worthless. So that's awesome because I'm buying it back at zero. And I'll sell this again and it'll be worthless too because it's at 129 and I'm not, you know. Oh, this is the last one that I did. This is the 126, 127. Let me change the price real quick. 127, 128, and then 130. Calculate. Pretty much the same thing. I just wanted to get that number right. This is the highest point, $91. Now I have an even bigger one because this one has more probability of actually being correct. I had done one earlier that was just pretty much like a dollar down. Instead of 128, I wanted to sell at 127. And it wasn't the same probability. It was a little less and everything was a little less. So this one has way more probability of actually, getting through. $75. So I will be selling back the 127 and it'll be, if it's at 128.25 at the end of Friday, I'll have to sell this back. I'll sell it back for $1.25, $125. I have to buy this back at $25, which is minus 50. It's because it's two of them. And then I would have to sell this at zero because 130, it never reached 130, so it's worthless. And still, the price that they paid me plus the $75 here, 125 minus 50, I would get 91 bucks. And on Friday, I get a $91 credit for sure. Okay, that's the way you would make the money. If on the in between there's a lot of downs and up and you want to make maybe more money, it's a strategy depending on what's going to happen, because if it happens to be shooting up and I see that it's shooting up, I kind of need to get out of the trade as fast as possible, and I still have an opportunity to make the money. If it does go that way, what I need to do is try to get out of those that I have. So that I'm selling, and instead keep the ones that I'm buying. So if it's going up a little bit too much, I buy back these for whatever price it goes up. If it goes up to like 130 or something like that, I buy them both back, which will be 130 times 2, to whatever, 260, and I will pay that 260 only because I know that this 127 and eventually this 130 will be going up. But a lot of times it doesn't end up like that. Sometimes it could easily shoot up to whatever number, you know what I mean? It could shoot up all the way over here, and then on Friday it shoots all the way back down. And that's usually what happens. Most of the time it will open up. Let me see if I can find an example here. Most of the time, maybe just in the day or maybe just in the week, it'll open up at a certain range and it'll close at that range for the most part. If you notice all of the gains, this is weekly. This is a good week ahead. This is a very good week ahead. And then little by little, the prices only move up little by little. There's fluctuations. Look at October. These are high fluctuations that are happening. But for the most part, you'll see that it's always just tiny prices moving up. Sometimes there's some crazy shit happening. Right now, we're at this squeezing point is what I want to call it. Because this candle right here, let me bring this down just a tiny bit. Actually, bring it down back. This candle here is sort of like a squeezing pattern, okay? It means indecision. When there's on both sides, when the tail and the head are too high, that means a huge indecision. Most of the time, maybe not on the weekly, I'm starting to see, but on the easier, on the closer days, whenever it's a long wick down, it means that it'll probably be shooting up, and the same vice versa. When it's a long wick up, it'll probably be shooting down. That's not always the case, but it just happens to be something that happens. You see here, it went supposedly, but then it went back up. Here, the same thing, shut down, but then it went back up, and it didn't kind of show anything. So I've noticed that it kind of only works on the smaller ones, and it doesn't always work. Look, this one's huge indecision, and then we have a huge shoot down. But it had more on the top. It just happens to be something that correlates. It's not always the same way, just correlates sometimes. Look at this one, and it kind of shot up, but then it just shot back down. Same, it's like if that made that decision one after the other. Okay, this is in the 15 minutes. So we have here a huge sell down, and the price is going down. Yeah, I do believe that this is going to be the right thing to do, even if the earnings or whatever. So I'm gonna go for this for sure. I only want one of these contracts. It's gonna give me. You can buy obviously two of those contracts and make the money or whatever the hell. It just shot up from 19 to 28, and then it's going back down. Interesting. I'm definitely gonna get in on this now. See what's up. Probably gonna have to put my password. And then they're going to hold the collateral of $100 just in case, but and that's the $81 that I would lose if it happens to go or whatever. And I buy this here. It's probably going to ask me for my password. So I didn't give there it is. I didn't give an options overview because this is not supposed to be an options overview, but if you do have a question, please let me know. There it is. I did the trade. It's already happened. It didn't go in. It hasn't gone in yet. It has to go to that price that I wanted to go to. So we'll see what happens. But that is pretty much it. What I can do, if I didn't explain it, I'm sorry. What I can do to make the money is, I did explain it. If it goes up too high, I sell it. I buy back those and I let it go up and I ride the wave, whatever wave it goes up, I do fine. But I've already learned that you don't, whenever you sell an option for an expiration date, don't pull out of it unless you are 100% sure that it's going to go against what you're doing because you see what's happening. Even if it does a huge price movement, you don't look at that. You just stay calm about it because each of these things is covering each other. Each of those plays they're all covering each other. They're just in case something happens. So you just leave it as it is, and I would end up getting the $19 plus whatever it is that comes out at the end. Okay, if none of that was explainable, I'll probably find out now when I look at the video. But if it was and everything's fine, then please ask as many questions as you guys want.